Okay, in our previous tutorial, we talked about the income statement and whatever it is that is contained in the income statement. So today I'm going to give you the format of an income statement. So let's say we have an income statement for a sole trader. So if the person of that of the sole trading business is maybe M Motowo, this is what we're going to write the now this is what we're going to write up the title for the income statement. So we'll say M Motowo's income statement for the year ended maybe okay, since my body is very small, I will trace this space for the year ended, let's say 31st November 2010. So the title itself carries a lot of marks. Once you forget to write up the title, I mean, someone will begin to wonder, what is this document? There are lots and lots of documents in accounting. So once you don't give it a title, then someone might want to say, what is this that is presented? Is this a statement of affairs? Is this the what? Someone won't be able to understand what you are presenting. So the title is very important. You can present the document very well, you get everything correct, but once you forget to write the title of that thing that you've represented, then it will leave a question mark. For me, I have a question mark. I'll be like, what is this as is representing? I don't understand this. And I can probably give you a 0 because I don't know what you are presenting to me. I'll be confused. So it's very, very important that whenever you are presenting an accounting document, you write the title of that document, because that is what will help that person to understand, or the end user to understand. So this is now the income statement that have been presented to us, and then you read through and understand everything. So this is the format of an income statement. So the income statement, like I said, starts with the sales. So this is the format. It has 3 columns. Okay. It has 3 columns. My body is very small. I don't know if this diagram will contain all the information that I've got. If you don't be able to manage to contain the information that I have, I'll probably delete this part and use this very able at the continuation of the same thing. So like I said, it starts with the sales. So first of all, you have to put in the currency for your country. So like here in Zambia, we use quarter, so I'm going to put the symbols here. So the first thing, it has the sales. The sales, like I said, this is the number of goods that were sold. So the sales. And then these other 3 tables, the reason why there are 3 tables is because there are adjustments that are made. So these other tables will be, these other columns, it has 3 columns. So the reason why it has 3 columns is because these other columns will be used for adjustments. So if there are adjustments made, you can use either this or that depending on the type of adjustment that you have. So testing, we have the sales. So the sales, the figure for the sales, we're going to put it here. And then after you sell those items, maybe you sold 10 items, and out of those 10 items, 3 items were returned to you by the customer. Say these were defective, so the customer that you sold those goods to decide to return them back. So it will have a deduction on the sales, and that is what is known as the sales returns. So sales returns. So the sales returns, you put it here, and you add brackets. Brackets indicates that you are subtracting. So the sales returns, you subtract them, and then you have what is known as the net sales. So after subtracting those, you have the net sales. So the net sales, net means clear. These are the clear sales that you have. So the net sales figure will be put here. Hope it's visible. So the net sales figure will be put there. So after that, you have the opening stock. The opening stock, the goods that remains in the previous accounting period will be brought back in the other accounting period, because you cannot discard the goods that remains after you've sold the other goods. Those that remains will be kept, and whether you purchase more, they will be added to those things that you've purchased. So the closing stock, the opening stock, the goods that remained in the previous accounting period will be brought the next accounting period, and that will be the opening stock. So the opening stock figure, you put it here. You put it here because we need to add the number of items that we purchased. So if you purchase other items in the new accounting period, those are the purchases, and they are going to be added to the opening stock. So the purchases will be, let's put them here. We may have adjustments, so we put it there, and then after we purchase those items from the manufacturer, you buy items from the manufacturer, and then those goods that you buy, depending on the supplier, maybe if the supplier or the manufacturer of those goods that you bought lives a little bit far away from where you live, you need some form of transport that will carry those goods and bring them to your place. So that is what is known as the carriage inwards, the cost for the transport that you pay when you want those goods to be transported to your place, or the place where you do business from. So that is what is known as the carriage inwards, the amount that you pay for transport, the carriage inwards. So the figure will be, it will be added on the cost. You buy items and then you pay for transport for those items. This is a direct expense. We add it to the purchases, because there's direct expenses that are treated like the way we treat the carriage inwards. So it's going to be added to the purchases, because it's a cost on the number of items that you purchased. We have the purchases returns. That one is going to be subtracted. So the purchases returns, you purchase goods, maybe you purchase 10 items, or 50 amount of goods, or 50 boxes, or whatever. And then you discover that out of those boxes that you bought, out of the 50 boxes that you bought, you discover that 10 of them are defective, or the goods in them are defective. Out of the 50 boxes that you've bought, you discover that maybe 10 boxes contain defective goods. You won't keep them, you return them back to the manufacturer or the person that supplied you with those goods. You will have to return them. So that will be a deduction on the purchases. You purchase 50 items, to 50 boxes of whatever, and then you discover that out of those 10 of them are defective. You return them back. So that will be a deduction on the purchases. So this is what is known as the purchases returns. Purchases returns. Purchases returns, and they'll be subtracted. So when you are subtracting, make sure you had brackets, because brackets represent subtraction. So yes. So again, out of those stock, maybe out of the 40 stock, the 40 stock that remains, you decide to draw maybe one box for personal use. You draw out one box for personal use, whether you return them back or not, but mainly it has to be returned back to the business. So you draw out one box for personal use or what. So those are what is known as the purchases drawings. So the purchases drawing, it will also be a subtraction on the number of purchases that you make. So you are going to subtract it as well. So stock drawings. So you had those brackets, and then the figure that you are going to have here will represent the number of items that you have now, the number of purchased items that are available now, and they are called net purchases. Like I said, net represent clear. So these are the purchases now that you have available. So they are called net purchases. So these are called net purchases. So now, after this now, you are going to add this to the opening stock, because these are the purchases, the purchases now that we have, the net purchases that we have, the number of goods that we purchased, the clear amount of goods that we purchased, here, the net purchases this is going to be added to the opening stock. The goods that for the previous accounting period, the goods that remained in the previous accounting period will be added to the goods that you've purchased in that accounting period, and then you have the cost of goods available for sale. Is it? You have the cost of goods available for sale. So you have the cost of goods available for sale. So these are the number of goods that you have now in the business, and they are available for sale. So now, out of these goods, you have these goods available for sale. And then out of these goods that you have now, let's say you have maybe 80 items available for sale, right? Or 80 number of goods available for sale. And then you manage to sell maybe 50 items. So the 30 that remains is the closing stock, and you have to subtract it. You have to subtract it from the cost of goods available for sale, because these are the ones that remains now, the closing stock. So this closing stock will now be the opening stock in another accounting period. So out of these 50 items that you've sold, 58 items that you had available for sale, you only managed to sell 50. And the 30 that remains is the closing stock, because these are now the goods that remains after those goods have been sold. So you subtract it. You subtract this, and then the figure that you have is the cost of goods sold. So these are the cost of goods sold. So the cost of goods sold. So the cost of goods sold is going to now be subtracted from what? The sales. So we're going to subtract this from the sales, and the amount that we're going to have is what is known as the gross profit. The gross profit. So this is the gross profit, means the profit that the business incurs before expenses were deducted, because this is known as the other name for this is known as the trading profit and loss account. This is called the trading profit and loss account. So this is the part for the trading. Now the profit and loss account, this is what the other part now is what is known as the profit and loss account, because that is the part that will now determine whether the business experienced a loss or a profit. But again, before we even go there, we've got other incomes that the business receive. For example, so under this you add other incomes. So let me wrap this part. Because my body is very small. I'll wrap this part, and then whatever comes after that will be the continuation of this. So I will have to lab this part. Okay. So now, this will be a continuation. Okay. Right. All right. So this will be the continuation. Now, there's another part here. Yeah. 1, 2, 3. Yes, just 3 parts. So we had gross profit. Gross profit. What was here? So the gross profit. Let me get another marker. Or let me get this one. All right. So we had gross profit. So gross profit, you add other income. For example, when you went to purchase 50 items or 80 items that you went to purchase, out of those 80 items, you had probably you received a discount. So that would be, so instead of buying your goods maybe at 700 kwacha, you bought those goods at 650. So that 50 quarter will be a discount received. So if you reduce the discount, it will be an addition to the gross profit. And the other situation where maybe you advertise, you sell goods on behalf of another company or another business, the money that you received after selling that item on behalf of another company, you receive, let's say, a commission for that. So that commission received to be the income to the business, so to be added to the gross profit. So here you say hard income. You had income. So here you say discount received. Discount received. There you had it. Commission received. Received. You had it there. And you have that. Figure there as your total gross profit. So now we are going to go into another part. We are going to go into another part, which is now the trading, the profit and loss account. This is now the part that will determine whether the business was running at a profit or a loss. So you say less expenses. On this part, you say less expenses. You say less expenses. So for the expenses, let's say if you have experienced bad debts, bad debts, so that becomes an expense to the business. Someone collected money from the business on credit, and after collecting money from the business on credit, or collected goods from the business on credit, that person goes mad, runs mad, or that person dies, or that person runs away without even returning the money back to the business. So that becomes a bad debt, and it will be treated as an expense to the business. So that is an expense. So there will be added. It will be put in this column, since we have lots and lots of expenses here. So bad debts, it's an expense to the business. And then you also have advertising. I don't know if this is the correct spelling. Advertising. You paid an advertising firm, or you paid a firm to advertise your business. You paid this firm is into advertising. You paid this firm because it's well known for advertising people's businesses. So you use it to advertise your business. They can't do that for free. They have to collect something in form of cash. So the amount of money that you use to pay that company that has advertised your business is an expense, and it will be treated as an expense because it's a loss to the business. The other name for expenses are losses to the business. And then you have salaries, the money that you pay your workers. You've got workers who work for you. So those salaries that you pay them are the losses to the business, and they'll be treated as one. So there are many of them. We also have discount allowed. Discount allowed. Discount allowed. This customer came to your business and made a huge purchase, maybe a purchase of maybe 70,000, and then you were impressed because of the number of purchases which they have made. They have boosted the business, so you were impressed to say you've bought. Nobody has bought items that worth this amount from me ever since I started the business. So therefore, I will allow you a discount of maybe this amount. So that amount, instead of paying you the 70,000, they will probably pay you maybe 60,000. 10,000 there is a loss to the business, so it will be treated as an expense. So yeah, so these will be your total expenses. Your total expenses. These will be your total expenses. So they are going to be subtracted from your gross profit. This is what now will determine whether the business was running at a profit or a loss. So if you have a figure here which is bigger than the gross profit, it will give you a negative figure. So that negative figure represents a loss. So if the figure for expenses, if you invest, if the losses exceeds the gross profit, that means the company has experienced a loss. So if you have a negative figure here, it will be treated as a loss. But if you have a positive figure here like this, now since it's Mutobo's account, probably it will have a negative figure. Okay, so if the business experienced a loss, it will have a negative figure. If it experienced a profit, it will have a positive figure. So like in this case, okay, let's try to be merciful. But this time he makes a profit. He makes some profit, so this will be called the net profit. The net profit. And this is the end of the income statement. So this is the format for the income statement. This is the format for the income statement. It's a very simple thing. So this is the income statement. So in our next tutorial, we are going to discuss now the format of the balance sheet.